warm welcome to the special edition. We are calling it the currency war, triggered by the Yuan devaluation. The debate only intensifies between the believers and the non-believers of what the recent step by the Chinese central bank would mean for world markets and for currency markets at large. Welcome to the show. I'm Tanvir, Gill with Nikunj, Dalmia, and it's a very tricky situation. You know, the world is guessing on which way things will progress.
You know, frankly, the Chinese central bank has set a cat amongst the pigeon by devaluing Yuan. In terms of magnitude, this is the biggest devaluation in last 2 decades. It's a surprise move, it's a shocking move, and it's a move which clearly tells you that the Chinese central banker will use all the tools in their toolbox to help the Chinese economy recover. This move surely is also an indication that China, for the better part of 2014 and 2015, they claimed that they wanted to kickstart their local consumer demand. That is not happening, and that weak export data certainly has raised question marks on China's ability to really export out. So currency war, deflation risk, a surprise move, we can connect everything up. But the attempt, I think, from the central bank is that they will do whatever it takes to kickstart the China growth engine.
And also the political angle to the whole debate, right? China's long-standing will to be the 5th global reserve currency, and you know what the IMF decides on doing with that over the next couple of months will also be a key indicator. In fact, the yuan continued its fall for the 2nd day on the trot after China devalued its currency to help prop up a slowing economy. It had its impact on currency markets, on equity markets. Will China weaken the yuan further? That's the first big question. Is this devaluation mirroring a 1997 type currency crisis across Asia and the world? Is China exporting deflation to the rest of the world? And also, the other key highlight of this ensuing debate is whether the rising deflation risk would mean that the Fed actually pushes back on its expected September rate hike decision. Aside of that, of course, Nikunj, you know, the yuan devaluation is not just for economic reasons. There's much talk about how they have been wanting to become a global reserve currency after the yen, pound, euro, and the dollar. That's also going to be part of this ensuing debate. And of course, whether or not this move is just to make a more reformed-based currency that would appease the IMF and, you know, clear the decks for them to become a globally accepted currency.
Frankly, the Chinese bank, they've managed to kill 2 birds with 1 stone. A weak currency will certainly augur well for the Chinese exporters, and B, then this also will shut down some of the critics who've been criticizing the Chinese government and the Chinese officials for not following for not really following a open currency.
Free market regime.
Free market regime is something which at least the critics now will not have a reason to criticize that.
Oh yes, indeed. Let's throw open the house to our guests and ask them about their perspective. We have a power pack lineup over the next 30 minutes. Marc Faber will be joining us with his perspective on the currency situation. We have Nick Parsons of National Australia Bank talking about his market strategy at this point. Atsi Seth, Senior VP Sovereign Risk Group at Moody's, will be taking us through the economic impact of this announcement and this development, and Dhawal Mehta of Somerset Capital Management will be tying in the India impact you know, in lieu of this big devaluation that China has done. Marc, I'll start off with you. Firstly, welcome to all our guests, but I'll start off with you, Marc. What is your own sense of this devaluation story and the jitters it's bringing about in world markets?
Yes, but we have to put this in the context. The Chinese, they let the currency float down by a tiny amount when we compare what the yen weakness has been, the euro weakness has been against the US dollar. About that, nobody talks, but that the Chinese would let the currency depreciate by a tiny fraction is making headlines everywhere. Now, I just want to say this. First of all, we don't know exactly why they did it, because a 2% devaluation is not going to help exports. And even a 10 or 20% devaluation is not going to help exports meaningfully in a world that is slowing down. And my view is rather that central banks around the world, they talk to each other. The Federal Reserve talks every day to the ECB, to the Bank of England, the Bank of Japan, and so forth. And the Fed may very well have actually told the Chinese, why don't you devalue somewhat? This will give the Fed an excuse not to increase interest rates in September.
Dhawal Mehta, this question is coming your way. From an equity market standpoint and from an emerging market standpoint, what changes? What will change now that the Chinese central bank is committed to maintain a weak currency?
Well, this is certainly a shock, for the markets in terms of the way it happened, and obviously we've seen, the currency kind of, devalue by 4 to 5% over the last couple of days, and so that has obviously had an impact on the region and also elsewhere. And as I see it, you will have to just wait and watch in terms of, what happens next. And so in that sense, markets will, to my mind, remain nervous for some time at least, and just to kind of see where kind of this leads up to. So in that sense, yes, it's going to be a bit nervous. It's going to be a wait and watch kind of approach for some time at least.
Right, Marc, come to you. And the significant devaluation, do you see more to come, or this is perhaps just a step in the right direction that the Chinese central bank needs to take to appease the IMF, to perhaps build their case as being part of the SDF?
No, I think it's likely that the yuan, which had been strong until recently, has turned the trend, and that from here onward it will rather weaken. And I think it could easily weaken from the recent peak by about 10%, which would not be that much, because don't forget, many Asian currencies and many emerging market currencies, they're down 30 to 60% over the last 4 years.
Nick, the other important global debatable point is that are we now in a regime of currency war? Every central bank, they want their currency to remain weak, because if the currency remains weak, automatically they can export and they can gain global market share, and that will heal their economy.
Well, I think there were both internal and external pressures on China. Internally came from the sluggish pace of domestic demand and export growth. But externally, there'd been a push from China to try to have more international recognition of the currency. Now, the IMF, in a report a couple of weeks ago, did make some fairly scathing references, at least scathing in its own terms, about the lack of market liberalisation and the degree of control that the Chinese authorities were still exerting over rates. And they made it clear that until this was more market determined, they would have to delay SDR entries.
Dhawal, let's talk about two aspects. Number one, what will happen to global risk off mode now that US markets, commodity prices are correcting, bond yields are moving up, and B, what could be the impact on India specifically? Will India gain because global commodity prices have come down, and the fact that the fears of slowdown in China are real and they have been endorsed by the central bank also?
Well, it's I mean, it's difficult to argue against that in some sense. I mean, if you look at the fact that most emerging market currencies have taken a knock, this year the US dollar has come back strongly against just about everything else, and so there is some credence to that kind of belief, and so there is obviously therefore fears whether whether we are heading back to the days where emerging markets took a big hit because of currency related issues. But I think, having said that, obviously, we'll really have to, kind of be in a wait and watch mode for some time before we really take a call on that. But I can understand why markets are, so concerned at this point of time.
Oh, yes, indeed. In fact, stay on with us. We'll carry on this discussion with our panel on the other side. Perhaps study a bit more closely the India impact, direct India impact of this devaluation story in China. But as we take that break, hear out the Chief Economic Advisor, Mr. Arvind Subramanian, his take on this ensuing crisis and what it would mean for India in the near term.
This action is both an endeavor to, make the yuan a more, plausible, credible candidate for inclusion in the SDR basket. But at the same time, there is no doubt that China is responding to its own internal development, slowing down of the growth and exports, in order to give its economy a boost. And all of us, policymakers around the world, including in India, have to take notice of these actions.
Well, welcome back. We are discussing the potential currency war that may have been triggered because the devaluation of the yuan. Over the last 2 days, the yuan has weakened considerably in excess of 2%, and that's causing jitters across equity and currency markets globally, not just in India. We're discussing the matter, in fact, with our panel of guests, and let's introduce them once again. We have with us right now Marc Faber discussing how this impacts global sentiment. Nick Parsons as well of NAB, National Australia Bank, talking about his market perspective. To tie it in with the India view, we have Dhawal Mehta of Somerset Capital Management. And I'll come to you, Marc. And, assuming that there was perhaps more devaluation from here, which, by the way, many are calling it a correction because, in effective exchange rate terms as well as trade-weighted index terms, the yuan over the last 2 years has been overvalued. It has been relatively stronger than other currencies. So many are seeing this devaluation as really a correction in an otherwise strong yuan. How do you see this impacting, if this was to continue, this correction? How would you see that impacting the Indian economy and the markets?
Well, I mean, people have very high expectations about the reforms in India and about economic growth picking up and so forth. And the process is slower than what was expected. I'm not negative about the Indian economy, but I'm not wildly optimistic either, because I'm familiar with the Indian bureaucracy, and to break the bureaucracy in India is the task of Hercules. And so I'm not sure that the Modi will succeed. But in general, I would say I hold investments in India. I did an ad this year. I think the currency will likely weaken further. And in dollar terms, I don't think that Indian stocks will perform particularly well.
Marc, okay. Fear of a slowdown in China has intensified, which means this is a death knell for commodities. So what will happen to oil? Oil is the biggest commodity in the world. Oil prices are down nearly 50% plus in a matter of just 6 months. Do you think it's a matter of not months, but weeks or days that oil will be decisively below $50 per barrel?
Well, we have reached a level that is very problematic for many oil producers. Even very low-cost producers like Saudi Arabia, which creates another problem because the Saudis, they need oil above $100 a barrel to cover their social expenditures, the living cost of the population that is largely idle. And so at this level of oil prices, Saudi and also other oil producers in the world, they have to liquidate their sovereign funds. Their sovereign funds are now shrinking. That reduces global liquidity, and it has a negative impact on asset markets.
Fair point, Marc. But William, the big concern, I guess, is that if the second biggest economy in the world is going through a period of stress, will that change or reset global growth expectations, A? And part B is that do you think the slowdown in China or the problems in China are huge? They are mammoth. It's just that nobody's acknowledging them.
Yeah, well, this seems to be the conclusion that many market participants are coming to. That that this is just further symbolic of a China economy where the slowdown is more chaotic than the official data is telling us, that they're getting a bit panicky. I think it's important so far, however, to see the move in the context of actually free-floating currencies, and this move is really only significant in the context of the renminbi's very artificially stabilized recent past, and actually in the context of free-floating currencies, this move so far is not one that would necessarily spark huge alarm, although it does seem to be provoking plenty of commentary. The other thing to point out, I guess, that's interesting, is that the real effective exchange rate for China has risen by around 10% in the last year, and that's while the economy has clearly been decelerating and monetary policy has been loosening. So it may be that the Chinese authorities are just looking for a currency that slightly more reflects the underlying economic environment. So,
William, do you expect the volatility in other Asian markets currencies also here to stay? Given that one side you got one central bank which has devalued their currency, the world's biggest bank, which is US Fed, is actually looking at increasing rates.
Yeah, I mean, that certainly seems plausible. I mean, the sort of the things that are clearly dominating not just Asian currencies but global capital markets right now, the thoughts of global capital markets are really twofold. We've moved on from Greece and now it's China, where people are worried that the slowdown is more catastrophic or more chaotic than the official data tells us. That story doesn't seem like it's going to go away anytime very soon. And alongside that, it still feels like the US economy is sort of preparing for higher interest rates. And that all spells to us volatility, not just in currencies, but likely in the wider capital market space too.
Okay, gentlemen, we leave it at that. Thanks very much for joining us and putting things in perspective. This is going to be a very interesting debate as we go along. And like I said, the divide between the believers and the non-believers in the China story only widens with this big move coming in from the Chinese central bank. In fact, putting in another perspective is Ananth Narayan, who ties in, the India impact on the currency, on the equity markets, with what's happening in China. Let's listen to him.
There were, of course, confusing signals which came out from the PBOC today. They did specifically say this was a one-off. At the same time, they also said that they would reference the previous day's market close, which, by the way, today has moved up to the 6.325 range today. So it'll be very interesting to see right away tomorrow as to what the fixing comes at. I suspect, as do most market participants, that we won't see a big change tomorrow. The forward points for Chinese yuan have already moved up, indicating that the market expects more depreciation to come through. And frankly, from a China perspective, as everybody has stated, I think it makes a lot of sense. This is not the start of a currency war. This is more like China responding to what's happened over the last 2 years. What China is doing right now is playing a bit of catch-up in the backdrop of negative export growth, in the backdrop of significant capital outflows in the last few months and weeks. In fact, in the last 1 year, their FX reserves are down by $350 billion, which is a significant number. Clearly, this is a move which is a reaction to what's happened in terms of dollar strength and will have ramifications for the rest of the currencies, given the size, the sheer size of the Chinese trade machine. 10% of global trade is coming out of China. It will definitely have an impact on the rest of the world.
It will, and that's why we are trying to get you a 360-degree view of how the story will play out in the coming days. That's Ananth Narayan summing up the story for us. And before we wrap up, we just want to address the big questions that this development has raised for world markets. The first question, of course, is does this yuan devaluation mirror a 1997 type of Asian crisis, currency crisis that is, and the jury is still out on that. In fact, Nikunj, it's not still a clear verdict. One will have to see and monitor what the Chinese central bank does from here. Yes, they do want it to become a global reserve currency. They are making their pitch to the IMF for it, but the jury is still out on this question. The yuan fall will lead to a sell-off in equities. It has indicated already some sort of risk aversion across equity markets, not just the Indian markets, not the Asian markets, but markets across the globe. So the impact on equities will be felt. Is China exporting deflation to the world? There is still some concern about it, which, by the way, would be a key influence on the Fed when it decides to move on rates next month. Because remember, the Fed is very clear about they wanting a higher inflation rate. They're looking at 2% inflation in the US. And if deflation is the story that China is exporting to the world, then the Fed would be concerned about their own asset prices.
The trade deficit for US balance sheet will improve because of the weak currency. US cannot afford to have such a strong and such a high trade deficit. Also, the strength in dollar is actually hurting US exports.
They're the only ones.
They're the only ones, which, because dollar is a powerful currency, it is the only reserve currency in the world right now. So central bankers are desperate to keep their currency weak. So all of them are trying to just follow a simple theory, which is export your way out to prosperity. So it's interesting times, unpredictable times. I think volatility is here to stay, but be rest assured that US Fed will not do anything in a hurry, anything which will be silly, anything which they will look back and say, oh, we should have acknowledged what was happening to the world and not just get blindfolded by what is happening to US unemployment data and commodity prices. But commodity prices are headed lower, which is great news for India. Let me also remind our viewers that rupee may have gone back to August 2013 levels, but the macros are much better than us. This decline, once the dust settles down, is actually great news for India, simply because of this hit which will happen, which will happen in commodities.
Oh yes, indeed. India could still turn out to be the bright spot in a worrying environment where there could still be some potential for yield and returns. On that note, from Nikunj and myself, thanks very much for watching the special show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.